You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, brought to you by CF Benchmarks, the world's largest crypto index provider. Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken O'Delega, Head of Content, and I'm joined by my colleague, Gabe Selby, who's Head of Research. Hi, Gabe.
Hey, Ken. Great to be here.
And today we are so stoked to also be joined by our guest, Ryan Rasmussen, who's Head of Research at Bitwise Asset Management. Ryan, thanks a lot for joining us.
Ken, Gabe, thanks for having me. I'm looking forward to it.
Brilliant. And a lot of you will know that Bitwise is, a specialist issuer of investment products, including ETFs, but of course with a crypto native, if you like, or crypto first ethos. And so it's unsurprisingly also been at the forefront of the newest and fastest growing ETP product class ever, which is of course digital assets.
A major congratulations is in order. Bitwise just crossed, I think, 15 billion in AUM across their product suite.
Yes, thank you. Appreciate it. It's been a long journey. I joined Bitwise in early 2021, and we were about 1.5 billion in AUM back then. So it's been a long journey, and we're really excited about it.
I mean, it's awesome to see how it's grown. It's particularly like with the race. It's kind of like an arms race, really, with the spot ETFs. And Bitwise, let's just face it, like relatively speaking, to some of these larger asset managers, has impressively made its niche. And like you guys have been able to really, I think, convey that message of they're crypto specialists. That's why you should go with us. Of course, there's all sorts of other great asset managers out there that are larger and maybe just, not as focused in digital assets, but you guys have been, always about this space. And I think maybe you've seen that with client conversations. How's that kind of played into the cards?
Yeah, I think that's exactly right. Our view is that there's specialists in every area of asset management. We don't think that crypto will be any different. And so our focus is solely on crypto asset management. We have over 100 people on the Bitwise team in the US and in Europe that spend all day, every day thinking about crypto assets, thinking about how they fit into the broader portfolio construction, talking with institutional investors and helping with both modeling portfolios and allocations, but as well as just the educational journey. And I do think that many investors that we speak to really value that because they don't have that much time to talk about or think about crypto on their own while they're running the rest of their portfolios and the rest of their business. But when they get that call from a client asking about Bitcoin or Ethereum or some deeper nuance, they know they can pick up a phone and get in touch with someone on our research team or in our distribution team and have a conversation with them and get an answer to their client quickly. So we found that has been working. We're really excited about it. And, hopefully we'll take that 15 to 50 billion soon.
Absolutely. And, gauging the temperature, Ryan, of the advisor cohort, if you like. We like to do that, every time we speak to, professionals in the market like yourself. Where do you think advisors are, the RIAs in particular, I'm thinking about in the States, in terms of their journey towards allocations? I mean, I've got from speaking to your esteemed colleague, obviously Matt, that we've passed some major inflection points, but there were, at least earlier in the years, 3 or 4 months ago, there were still some pockets of outliers, still some, maybe you could say pockets of resistance and some major, still some major hurdles to overcome before you could actually get to the stage where, the floodgates were truly open. How would you characterize where we are right now in terms of that?
We're still incredibly early. I wouldn't say to use the baseball analogy, I wouldn't say we're at batting practice, but I would say we're somewhere in the first or second inning, which surprises a lot of people. But the reality is that majority of the adopters of spot Bitcoin ETFs to date, as well as spot Ethereum ETFs to date, have really been retail investors, hedge funds who are using those as part of a two-sided basis trade, or early adopter financial advisors. But the majority of professional wealth managers in America still don't even have access to these ETFs, which is kind of mind-blowing because Bitcoin ETFs launched back in January 2024. Ethereum ETFs launched in July 2024. But the reality is these large wealth management platforms do just move extremely slow, in part because the regulatory pivot didn't really start until the end of last year, beginning of this year. but also because crypto is a really small part of their overall business. And I
Yeah.
think a lot of crypto enthusiasts don't understand that these wealth managers are focused on tariffs and interest rates
Yeah.
and equities and bonds and geopolitical tensions. And so they don't spend that much time thinking about crypto. And if you kind of follow that thought process onto the investment committees and the due diligence and risk departments in these large firms, they're just not going to move as fast on these things as people would like. So what that means is that we're still very early in adoption. And even those that are adopting, the early adopters, the RAs, they start with a small percentage. They start with like 1% allocation to Bitcoin. Then maybe they'll grow it to 2 or 3%. And we typically see it cap out around 5%, but it's still mostly in that 2 to 3% range. And then of course there are some who have a higher allocation to crypto in the broader portfolio, like 10%, 15. Some we even see 20%, but their clients are typically younger, maybe made their money in tech, and so they're a little bit more tech savvy, or they have a little bit more appetite for risk. But we're still very, very early.
They're playing catch up, maybe.
Yeah,
Yeah, they haven't.
that's right.
They weren't so disciplined early on in their retirement planning, and now they're like, let's put 25% into Bitcoin, and
For better or
let's,
worse, yeah.
yeah, for better or worse. I would have to agree with that, and I don't know if this is like an anecdotal observation, but when we look at conversations that we've seen with our institutional clients, it does feel like this cycle, maybe digital assets aren't being talked about as much as they were in like 2021 in that bull run, and it's marginal, but like I just feel like I'm not getting as crazy of conversational like flare ups in digital assets coming up in my personal life, but there is still a lot of interest. What that means is that it tells me that we're not really in that kind of peak euphoria, I don't know, peak euphoric phase when the taxi driver in Manhattan's giving you
Absolutely. Yeah. Yeah.
token recommendations on some meme coin, but you're really like you're seeing the adoption pick up, but like you said, Ryan, it does feel like it's still incredibly early, particularly with these larger institutions that just can't move quite as fast. And I think a lot of people have this miscalculated, because what's so different about this cycle versus the previous ones is that we have this kind of regime, this regulatory regime that's particularly favorable, despite the fact that maybe you'll see that the Fed funds rate's still hovering north of 3 and 3.75 4%. I don't know where they have it set at right now, but it's still particularly high. That hasn't really impacted the space as much, because you have so much bullishness and all this these tailwinds really from the regulatory side, right?
Yeah, absolutely. I think you have an insane amount of pent up demand that the ETFs and the regulatory developments have started to release. But I mean, it's like a drop in the bucket, or like a trickle right now. And I'm excited for when the full release happens over phases over the next couple of years. But I do think you're right. We haven't seen that euphoria hit. There's been little like
Bursts.
glimpses of
Yeah.
it, like when
Yeah.
Donald Trump launched a meme coin that seemed like a peak euphoria moment, right? Or with the Bitcoin and Solana and Ethereum treasury companies, it seems like a little bit of euphoria. But for the most part, I think leverage actually isn't that high in the system, which is typical a sign of euphoria. And one thing I find particularly interesting about what you mentioned there, Gabe, is where we're at in interest rate cycles relative to the market growth for crypto. And historically, Bitcoin's done really well in low interest rate environments. So it's a little bit remarkable to me that we're hitting new all-time highs while interest rates are, 4% plus, which is a very high level in Bitcoin's relative history, right? It existed for a long time where interest rates were much lower. So the fact that we're already pushing new all-time highs while interest rate cuts haven't really started yet is remarkable to me, and I think sets up a massive tailwind heading into Q4, heading into 2026 and beyond.
Yeah, that's good.
Yeah. I mean, the other thing is, and I want to get you guys, you practitioners, to talk about where we are in the market, the euphoria. Speaking of euphoria, or the lack of it, lack thereof, we're back at around about 111. Last I checked, we had a little bit of a lull in recent weeks. The usual potentially seasonal effects, due to perhaps low volume around the vacation season, and now we're heading into a time that's historically, volatile for risk assets. But what are you guys' take on where we are? We've had a bounce. we can put it down to all sorts of simplistic factors, but what are the more plausible drivers from your points of views, guys?
Yeah, I do think seasonality is playing a bit of a role here. September historically is a relatively bad month for Bitcoin. It's one of the only down months in Bitcoin's history when you look at monthly returns on average going back over a decade. So, as you mentioned, that also exists against other asset classes and stocks because it's summer. You have low liquidity levels, low volume levels. That does lead to, some volatility and some random spikes here and there. But typically, you have a comeback trade, right, in Q4 and then heading into the next year and continuing in through May. And so I do think that's happening here. I also think investors just don't really know what to do. Like you have the trade war starting in April and like crazy tariffs, and then there's calm. And then all of a sudden this week, the tariffs like tantrum is back on. And meanwhile, you have mixed signals on interest rates and other macro data like inflation and can you trust the BLS anymore? I don't know. Is Trump going to fire Fed governor? Like no one knows, and I think that's leaving investors a little bit skittish to go risk on. But I do think that as the uncertainty calms and as we get through the seasonality, that investors, and I do believe interest rate cuts will happen. I think investors will go more risk on, and that'll bode well for assets like Bitcoin.
Yeah, I think those are all great points. My thing that I would add is that we've seen such an incredibly low volatility regime here with Bitcoin price. So we look at our Bitcoin volatility index, which measures the implied volatility on CME options. And that's been hovering, at the 12-month low range of, implying 35 to 40% implied vol for Bitcoin. But when you look at the actual realized vol, so the actual like price movement of our reference rate, it hit an all-time low of 24% annualized. So, I mean, Bitcoin's hitting, I would say, developed market equity level of volatility as an asset that typically had a multiple of like 2 to 3 times that of, let's just say, large cap equities. Now, we've had some dynamics that have changed. In fall of last year, we saw the SEC approve options, covered call options for these ETFs. And we've seen those products particularly gain a lot of interest in AUM. That's created, I think, a dynamic where you're seeing a systematic selling of Bitcoin volatility. And that, I think, has helped kind of keep Bitcoin's price on a relative standpoint much less volatile, while at the same time making new all-time highs. So what does that do for investors? Well, if Bitcoin continues to perform well and it's exhibiting less volatility, that tells you that's generating strong risk-adjusted returns. It always had strong risk-adjusted returns if you studied Bitcoin's return per unit measure of risk. But now it's even, I think it's skewing even better. And we always do that in our monthly market. We show sharp ratios of like things like Ether, Bitcoin, global equities, bonds. And you just see like, the past 12 months, Bitcoin's just really done particularly well. I think where we are in the market, that's a good question because it's all happening at this time where you're seeing, I think, finally, the markets, the bond vigilantes are really coming out against, sovereign debt. So there's this really interesting chart over crypto Twitter last week where we saw like, I think all these 30-year bond yields rising. I'm not sure who had it, but, and you're seeing all this basically long-term bondholders saying, we're not getting compensated enough. So they're not bidding it anymore. Mm-hmm. And at the same time, we talked about the regulatory regime, which is very favorable for digital assets. And that's kind of built this, I think, perfect storm really for Bitcoin to perform well. And I think that's the reason why you're also seeing gold perform well, year to date. But I think this is all creating this perfect storm. And it's something that we I think rightfully called in December of last year when we did our 2025 market outlook. We were saying bond vigilantes, keep an eye on bond vigilantes, because we knew when you get a regime of more government spending, and now we're seeing Fed independence come into question. Well, that can only mean one thing: you're going to have to debase the currency, right, to service the debt. So it's all a debasement trade in my eyes, and that's what I'm going to stick to. And Bitcoin is just a nice timely feather to add to your cap if you're a multi-asset investor and you're trying to hedge yourself against these risks. And so I think, Ryan, you're spot on. BLS data, let's keep an eye on like inflation prints. It certainly feels like the inflation is running hotter than what we're seeing, and I think your colleague Matt Hogan would always agree with the what's he always mentioned these this formula that he used to to smooth out inflation. He hates it. I think
Yeah.
he brought it up in our in the podcast that when he was on here last time, and I think that people are just going to start questioning that a little bit more, paying more attention to
Mm,
inflation,
mm,
purchasing power,
yeah.
and overall the fiscal health of the U.S. government for once. So
Yeah, I think at minimum you don't know if you can trust the data, which is just as
Yeah,
bad as
that's what we're getting nowadays, isn't it? Yeah, yeah,
yeah, it's just as bad as not being
yeah.
able to trust the data. And I think that investors are seeing this play out in real time, and they're thinking to themselves, how do I hedge against this debasement and growing deficits and spiraling inflation? And there are assets like gold, and there are gold like assets like Bitcoin. I think that's exactly why we're seeing more and more interest in Bitcoin. Certainly in the conversations that I'm having with CIOs and investment managers, everything from smaller shops up to pensions and endowments are talking about this. And I think what's interesting is like 2 or 3 years ago in these conversations, when you bring up Bitcoin's a hedge against debasement and spiraling inflation and runaway debt, they would look at you like you're crazy and you don't understand macroeconomics. Now they're asking these questions and eager to understand, okay, like how much of it should I own to properly hedge? And it gets into what Gabe was saying around like what's the optimal allocation to increase your Sharpe ratio on a risk adjusted basis and returns basis. So I think it's all coming together, and for better or worse, the issues aren't going away with the US government. And so what is there to do other than try to position yourself accordingly?
Ryan, basically, I thought maybe, focus quite tightly on the regulatory piece. And of course, thinking about the SEC most recently was the approval of in kind. Do you have any sort of like major impression? I've got a few questions I want to ask on that, but I just wanted to maybe test the waters a little bit. Have any impressions as regards that approval, the impact, what you expect going forward, and anything at all?
I think when it comes to the regulatory pivot, you're seeing the actual groundwork laid with things like the approval of in kind creations and redemptions. Of course, that's for Bitcoin and Ethereum ETFs, which today are the only spot ETFs. But you can imagine a world where there's many different spot ETFs and this type of creation and redemption process is approved. I think what that does, first and foremost, is it makes these products more efficient, which benefits end investors. It lowers tracking errors and it improves spreads. It has deeper AP participation and in general just easier participation from financial institutions, which is all net positive. I think at a higher level, this just levels the playing field for
Yeah.
crypto ETPs against other commodity ETPs, which for us was always the argument, which is why are we treating crypto assets differently than we are other products? And so we're really excited about, of course, the benefits to end investors, but I think the regulatory through line here
Yeah.
is that we're at least operating on a level playing field. And I think that through line will bleed out into all other areas of the market beyond ETPs and beyond nuances like in-kind creations and redemptions.
Yeah. The key thing that I had with this was clearly, we all know about the efficiency gains, the fact that the familiarity, the normal rail operational rails for, issuers and beyond that come with in kind. But looking at the Bitcoin and Ether ETF market, clearly there hasn't been a huge amount of impediment, particularly on the Bitcoin side, from the lack of it to date. But of course, looking further afield or looking further forward on the horizon, when we get these additional assets that are going to be wrapped in the ETF wrapper, maybe that's when it would have perhaps a bigger impact. Again, the other aspect, of course, is specialist firms, maybe not necessarily like yourselves, because you guys are pretty massive, but you smaller firms who are trying to sort of like eke out some sort of like an enterprise in this space. Maybe again that could have been a deal breaker, the lack of in kind create redeem. So maybe I was thinking maybe that's what the market and the sort of like people like yourselves were pushing for, to actually remove that barrier, but thinking further afield and further down the line. Is that the case, or what is your perspective on it?
Yeah, I think that's exactly right. Like what it allows is for APs to be involved in the market when perhaps they wouldn't have been before without in-kind creates and
Yeah.
redemptions, which again just makes the markets deeper and improves the efficiency of the products. That matters more and more, both the lower the market cap of the asset and the smaller the firm, because every little
Mm.
basis point of efficiency is massive when it comes to those products. And of course, what's happened with these spot ETPs is that the fees are, I would say egregiously low,
They
right?
are
It's
pretty low. Yeah.
cheaper to own a Bitcoin ETP than it is to own a gold ETP, for instance. And so every little bit of efficiency matters both to the issuers, and of course that benefit knocks on to the investors. So it does impact smaller issuers more. It impacts smaller assets more as well. And I think what this will also do is help guide what the SEC ultimately rolls out for their generic listing standards that they've been talking about. And I would be surprised if in-kind staking or in-kind creation and redemptions isn't part of that generic listing standard from the jump for these other assets. So that's great. There's knock-on benefits to very large holders, right? Where now they can actually contribute their Bitcoin if they can work with an AP directly into the ETP, and they can avoid tax implications,
Yes.
which is
Yeah.
great for whales and very, very large investors who have those relationships already. The average retail investor doesn't see the improvements of these in their day-to-day interactions with the ETFs. But of course, like I said, the knock-on benefits are huge.
You mentioned something there, the listing standards for what the SEC has been working on, what we're all kind of holding our breath for. Do you mind just giving like a quick lay of the land on where we're at? Like why are these multi-token funds being held up? What's the deal? Because I think, for most listeners, they see these incredible, tweets from the Bloomberg intelligence team, James Seifer, Eric Balkunas, who cover it very closely. And then there's always like a delay. They're holding stuff. So are you able to kind of give a breakdown, I guess, where we're at in this cycle?
Sure. Yeah, James and Eric are great and are extremely helpful to the space, and I love their analysis and coverage of it. I think, given from what I'm just seeing externally from what the SEC is putting out into the public, whether it's speeches by Hester Peirce, who's leading the crypto task force, or by Chairman Atkins himself, I think what we're ultimately seeing is that they want to do this right. Now, I think it's moving slower in some people's eyes because there was this need to disentangle what the last SEC regime did, which took a few months at a minimum. And you can see that happening with the in-kind creations and redemptions. Had they not had to spend time and energy focusing on that during this year, and it was just done when these products launched, then they'd be focusing on more forward-looking things like perhaps multiple asset ETPs, generic listing standards, things like that. I think with the generic listing standards specifically, the goal is to level the playing field so you don't have this process, which we've seen play out in the past, which is abnormal for bringing products to market, where it's not a first to file is first to approved, which is typically how it works in other ETFs and other categories. What we've seen, of course, the Bitcoin ETPs, which we originally applied for in 2019, was that there was 11, I think, that all launched on the same day, which is great for optionality for investors, but is again abnormal from other ETP launches for other categories. And so I think these generic listing standards are meant to be the SEC's push into leveling the playing field, both for issuers, also for projects and assets, and also for investors, so that we can just bring products to market more efficiently, that it's clear on what products can and can't be brought to market in ETP format, how that should be done. And then I don't think you'll see as many of these deadlines and then delays and then deadlines and delays, which are super nuanced on okay, well, there's a 180-day period for this, then there's a 60-day comment period, then there's a first deadline, but that's not actually the real deadline. The real deadline's 260 days later. And then even if a decision is made, it could be stayed by one of
It's
the
been
commissioners.
Byzantine.
Yeah.
Yeah, it's been
Yeah.
absolutely
Yeah.
Byzantine. Yeah. I just on the same theme, actually, Ryan. We've all seen that. Speaking of James Seifert, Eric Balkunas, who become quite seminal in the space due to their expertise and visibility. You probably saw a few days ago the absolutely enormous list of current applications on the slate for spot crypto ETPs. There's a huge amount of stuff in there, and there's a few crazy things in there as well. Let's be real. Now, I don't necessarily think I'm not going to sort of go to the extent that there's like a bonk or Trump, I want it to be entirely democratized, entirely liberated. And I think, you've got to have a similar sort of like atmosphere as you do for any asset class. I do expect that. But inevitably, there's certainly a question for a potential lack or drop in quality or, governance and all sorts of like concerns. Is that something that worries you at all?
Yeah, I mean, look, that list is incredibly long. I think I had to like rotate my screen 90 degrees just to get it all in one image there. But I also think that like ETF issuers are in the business of launching products that gather assets. And so you're going to continue to see issuers file for as many products as they can, as long as they think they'll be able to drive assets into those products. And so, what does that look like for the end investor? And does that mean that some investors will invest in products that do worse than others? Absolutely. I think that
Yeah.
will happen. But I just think that overall, it's great that investors have that choice now and are operating on a level playing field. A lot of people get confused, like, why would I buy an ETF if I can just go buy it on Coinbase or Gemini or Kraken? And they don't understand that institutional investors can't do that on behalf of clients, and they don't understand that it's much more expensive to do it that way, and you don't get access to institutional grade custody and regulation and auditing and all of those things that come with the efficiencies and the regulated elements of ETPs. And so I do think ultimately it levels the playing field for all of these different projects and for investors and for issuers. But you're going to see with that, great products come to market and many products that come to market and then fizzle out, which is not abnormal for other sectors of
Yeah.
the investment landscape.
Yeah, I think it'd be cool to kind of turn the page to the context of where we're at right now with what's on the, let's just say, like on the docket of these launches. And we're looking at a lot of multi-token baskets, right? That we're waiting on. So most crypto ETPs, ETFs, they're really just concentrated in a single token, Bitcoin and ETH right now. What would be the advisor investment case for an advisor and for individuals for having a multi-token, for more of like an indexed approach, more of a basket approach? Some people might say, like, the crypto market's relatively concentrated. If I have Bitcoin and Ether, what else do I need? But I'd love to hear your take on this.
Yeah, I think there's three elements of that I would touch on. I would say that the first element of this is that indexing is how most investors approach every other asset class. And so why would you treat crypto any differently? That's the base case for indexing the space. If you think about an institutional investor who has 1,000 clients and is managing a bunch of money, they don't have time to go out and pick individual stocks, generally speaking, or individual commodities. So to think they'd have time to go out and pick individual crypto assets when it's just 1% of or 2% of their portfolio just doesn't make sense. And so what they typically do is they choose a couple model portfolios or index funds, and they allocate a bunch of their clients to it with a few toggles here or there. And we believe that a crypto index or basket will be a core piece of those portfolios for institutional investors if you look out 10 years from now. It's just the easier it's like the easy button for investing in the crypto landscape. Of course, Bitcoin and Ethereum are like something around 80% of the market. Once you start to add other assets like Solana XRP, you get above 90% of the market. So then the argument would be, why wouldn't you just hold Bitcoin and Ethereum? That brings up, I would say, my second point, which is if you were investing in the internet back in the early 2000s, you could have just bought something like Google and you would have done well. Like, don't get me wrong. I wish, that I had a bunch of money and just bought Google in 2004, and great, because it was the biggest asset in the internet space. It was dominating search. It was the obvious play. But if you had just bought and held Google, you would have missed things like Salesforce, and you would have missed things like Amazon, which disrupted retail and changed the way that we interact with stores and e-commerce. You would have missed things like streaming with Netflix, which actually outperformed all of those assets since the
Mm.
early 2000s, since 2004. And so I think that's the argument also for indexing, is that you can try to pick one and you might do well in crypto because we're so early in the journey if you just
Mm.
pick Bitcoin.
Mm.
But odds are that picking winners and losers is more difficult than taking the indexed approach. And I think that just leads to the third point, which is that passive beats active like some insane amount of the time across every asset class. It's like 90% or more across active management passive wins, and so I think that there's no reason to expect that crypto will be any different.
I think I like that last point particularly. Well, I think all the points were uh, very accurate, very based, as the millennials would say. Um,
You're a millennial, aren't you?
Yeah, thank you.
or I'm sorry, Gen Zers. Gen Zers.
There you go.
Yeah, you're right. I just outed myself as a millennial. All right, I am a millennial. But the thing that I would say is, like, what if you owned Yahoo? Like, you picked Google, which is a very strong performer, still around, but Yahoo was a very dominant search, platform as well, and you could have maybe taken that choice, an active bet. I'm just going all in on Yahoo, and look at where you've gone. You've probably gone nowhere. So I think people don't realize the concept of active versus passive risk. If you look at the universe of tokens, right now the market is saying, like you said, you got your Bitcoin, you got your Ether, your Solana, your XRP, that's 90% of the market cap. But that's still 10% that's missing. And if you're not allocating into that, at least in a passive way through basically like what's the market weight, you're taking an active bet to be short those names. You're essentially not getting any exposure. So is that how you all are constructing this approach? Are you guys taking like a market cap weighted approach versus maybe doing something different?
Yes, I think that's a great point. By the way, is you would have, had you picked the wrong horse, then you would have been left behind. And how frustrating would it have been to be right about the internet, but to have gone all in on Yahoo, and be sitting here today kicking yourself. So I think that's exactly right. When we designed the Bitwise 10 Large Cap Crypto Index, which we launched back in 2017, we took a similar approach to that index as you would to indexing any other commodity or equities market. So it's a market cap weighted index of the top 10 crypto assets. And then we screen for a bunch of eligibility criteria. These are things like security risk, regulatory risk. We look at liquidity. How much trading volume does it have on an average daily trading volume basis? Can it be held by a regulated custodian in the US in cold storage, in institutional grade custody? How many exchanges does it trade on to ensure that we can enter and exit positions if we need to? We looked at all of those things. And so what you get is the top 10 crypto assets by market cap, but the 10th asset in that index is like the 25th largest asset by market cap because you've screened out things like stable coins, for instance, or you screened out things that from a legacy basis have a high market cap, but they don't actually have a lot of liquidity. They don't have a lot of trading volume, or maybe they aren't supported by custodians. And you do miss some newcomers in that approach because they aren't yet supported by exchanges and custodians. But I will say, having back tested this and looked at a number of different scenarios, there are a lot of crypto assets that make their way into the top 20 or even to the top 10 that falter. And you can think of projects like Luna or that famously imploded back in 2022. You can think about the FTX token, right, which made its way into the top 10 by market cap, but because it didn't meet the different eligibility criteria, like being supported by custodians and having enough trading volume and things like that, we did not have it enter the index, and therefore investors missed out on those. So I think it is a great way to get passive exposure to crypto as you would with other spaces. It rebalances on a monthly basis as well. So you don't have to worry about if XRP quadruples in a month. Now all of a sudden you have 20% exposure to XRP and you're under exposed to Bitcoin, Ethereum. The index automatically rebalances on a monthly basis.
Yeah. Let's move on now to something which is an essential piece of research by the Bitwise team, written by Ryan, along with Matt Hogan, CIO of Bitwise, and other members of the research team. Released quite recently. It's called Bitcoin Long-Term Capital Market Assumptions. You'll find that it's packed with striking stats and compelling takeaways. I mean, I'll just give you an example. Really bold one. Half of all US current account debt, currently approximately $36 trillion, was accumulated in the past 10 years. So if you look at the chart, obviously you're looking at a parabolic, as Gabe says, hockey stick after a sort of like obviously an acceleration into that period. And that obviously has major implications for crypto assets, chiefly Bitcoin, thinking about the debasement theme. But Ryan, I'm really keen to get you to characterize what your key takeaways are from this research for people.
Yeah, well, thank you. I appreciate you highlighting this report. We spent a lot of time on this, and the reason we even wrote this report is because every other major asset class and major asset manager has long-term capital market assumptions, stocks, bonds, gold, etc. JP Morgan, BlackRock, PIMCO, all of these asset managers write long-term capital market assumptions, which are really just long-term forecasts, not only of returns but also of volatility and correlations, which are important for portfolio managers as they consider how they want to construct a portfolio. Those exist for all other asset classes. They don't exist for Bitcoin until now. So we wanted to write a piece that would allow portfolio builders to understand how Bitcoin fits in a portfolio relative to other asset classes. And, an interesting anecdote is that up until last year, we'd had 0 requests for capital market assumptions ever since 2017.
There you go.
And then in the past year, of course, with the
Yeah.
launch of ETFs and of course with the
Yeah.
regulatory pivot, we're now being asked about this on a regular basis. And so we decided to be the first asset manager to put out long-term capital market assumptions for Bitcoin. I think the big
Brilliant.
takeaway here that we have is that we think Bitcoin is moving into its institutional epoch. It's graduating from a niche asset into a mainstream institutional asset. We believe that's going to lead to outsized returns over the next decade. We believe Bitcoin will be the best performing major asset over the next decade. But I think people get lost in the returns and the price targets that we have. For instance, in this report, we believe Bitcoin will hit 1.3 million in our base case in 2035, which of course is fun. Everyone loves price targets. But I think what's more important here is that we believe that will happen while volatility falls over that 10-year period and while correlations to stocks and bonds and other asset classes remain relatively low. And so what that means is that Bitcoin looks increasingly attractive as a component of a portfolio than it ever has before on a risk-adjusted returns basis. So that's what we're most excited about when we took a step back and looked at what Bitcoin could do over the next 10 years.
I think that's like an asset allocator's dream, like that formula that you just broke down as far as all the attributes, all the characteristics that we're anticipating to unfold here with Bitcoin. As someone who used to sit on the investment committee at an institutional shop, the capital market assumptions piece is really the foundational framework of how you allocate capital. You typically do this once a year, coming up with your strategic allocation in your model portfolio. So you look at your expected returns on your equities, on your bonds, on your commodities, on your alts, and you look at things like your volatility, your correlations, and really, like, it's amazing to see. Kudos to you all for doing this exercise and bringing this up to the light, because if you expect these types of institutional investors to adopt Bitcoin or to adopt this asset class, you need to kind of conform to their institutional investment frameworks. So you kind of have to provide this information so they're comfortable and looking at the asset class the same way they do with other asset classes, and they know, I guess, how to measure, their sizing, their positioning, their expected returns, and they can kind of have a view on it. Otherwise, I guess, you're expecting them to more or less fly blind, and that's they just typically won't agree to do that. So no, I think that's really cool. Everything that's going on with the CMA piece. Do you have any other, maybe sneak peek previews for the listeners on stuff that we could expect, on stuff that the Bitwise team's working on, or do you want to keep it under wraps for now?
No, would love to tip my cards a little bit there. So we published the long-term capital market assumptions for Bitcoin I guess last month in August. We're going to update this every year going forward. So you can expect an update for this piece in Q1 2026 and then every year thereafter. We're also writing one of these for Ethereum. So we're going to publish long-term capital market assumptions for Ethereum as well on an annual basis going forward. We're excited about that piece because it takes a completely different lens of that asset than Bitcoin, as they are very different. So that will also come out in early 2026. I would say in the interim between now and then, we publish a quarterly crypto report, which is intended to be like JP Morgan's guide to the markets, but focused on crypto. It's like 70 slides of charts that cover everything from the macro down to Bitcoin, Ethereum, market liquidity, DeFi, futures, things like that. And then every year we, which I really enjoy putting these together, and the market seems to really enjoy consuming these, we put together our predictions for the following year. So in December of this year, we will put out our 2026 predictions for the crypto market. And of course, we'll recap our 2025 predictions to see how we did there. And those are the big pieces that we're excited about.
I respect that you guys do that exercise of grading your predictions every year. Like we at CFB, we're not quite there yet. I think we'd have a pretty good track record. I mentally
I think
keep
so.
track in my mind. I say, you know what, we got that one right. And then the ones that didn't work out,
You
we
forget
just
those, right?
Yeah.
have to predict the future. And I think a lot of
Yeah,
folks understand that.
Look, if you're not getting some wrong, then you're not making bold enough predictions, right?
absolutely.
100%.
Absolutely. Yeah. Just real quick, actually, Ryan, you mentioned potential long-term capital market assumptions for Ethereum, the other major, the other large cap, basically, without, spoiler, the financial equivalent of a spoiler, or maybe even some, getting into deep regulatory or compliance waters. Is there anything, because I mean, obviously what we're looking at for Ethereum is not quite radical change, but there's definitely been a change of tone. It's a bit of a renaissance on several fronts for Ethereum right now, price wise, network usage. Obviously, we had the sort of upgrades earlier in the year, and that sort of like is part of the picture. Is there anything you can tell us about the longer term assumptions about Ethereum that maybe differs from really what the kind of anecdotal assumptions that most people held for Ethereum for many, many years?
Yeah, certainly. Like I think that, for Bitcoin, the drivers are relatively simple. If you think that currency debasement is going to continue, if you think that the US is going to continue accumulating debt and operating a deficit, and if you think that there's no way to hedge against this entirely, then a great escape valve for that is to allocate some capital to Bitcoin and or gold. It's a pretty simple thesis, but of course Ethereum is more complex than that. And Ethereum's different than Bitcoin. There is a reason why they both exist, because they solve different problems. And what that means is that the driver of capital flowing into Ethereum is going to be different than the driver of capital flowing into Bitcoin. For us, the way we think about Ethereum is as an operating system for crypto applications. And so as use cases grow for crypto, like stablecoins, like tokenization and DeFi and other use cases, the underlying operating system or network is likely to accrue some of that value and to grow as well. Now, things like this regulatory unlock, of course, are beneficial to Ethereum, because as we pass stablecoin legislation like we did back in July, that means that more and more stablecoin products are going to come to market. And of course, something like 60% of stablecoin activity settles on Ethereum. So you can just play that scenario out where if Scott Bessent says that the stablecoin market is going to be something like 3 trillion in the next 5 years, you can imagine how that flows down onto Ethereum. And so I think, for us, our view of what drives Ethereum is fundamentally different than what drives Bitcoin. We think of it more as a disruptive technology play than a hedge against fiat debasement and fiscal instability and runaway inflation, which means, in our opinion, that investors should have allocations to both, just like many investors have allocations to gold and bonds and to stocks that are like tech stocks and disruptive technology. So that's kind of our general thesis. And of course, we'll lay it out in a more data-driven way in this report.
Brilliant.
Yeah, I think so. One thing that's really interesting is that when we're talking about the use, or I guess one of the major benefits of indexing and having a diversified exposure is that, you're going to see these protocols, outside of Ethereum, maybe these oracles, maybe these other infrastructure plays on the blockchain that are going to play a significant role on tokenizing these RWAs. So this thing's happening. It's happening very quickly. We're starting to see a lot of, let's just say, incredible announcements of all these tokenized stocks. At first it was the money markets, right? We saw tokenized money markets, but now we're seeing ETFs, stocks. It's just kind of interesting that we've, particularly, you, Ryan, at the Bitwise team, the rest of you all have dedicated so much of your career getting these tokens to be in ETFs. Now we're starting to maybe put these ETFs back to the
These
token
tokens,
form.
yeah.
Is there, anything that you can share? Like, is Bitwise looking at how to play in this game with all these different movements that you're seeing with tokenization, since you guys are, a really large crypto ETF issuer?
Yeah, look, we're always surveying the market and trying to identify trends that will persist for the long term. I think a lot of investors that we speak to are eager to gain exposure to stablecoins and tokenization. And what that likely means is not investing in tokenized stocks directly, but investing in the infrastructure and service providers that facilitate that. So, of course, a well-known facilitator of tokenization over the next 10 years will be firms like Robinhood, who have gone kind of all in on tokenization. But you also have the underlying technology that services it, like Ethereum, Solana, and other programmable blockchains. So I think what we're looking at doing is how do we ensure that investors are able to express their perceived growth of tokenization in an investment product? And what does that look like? Is that investing in the underlying crypto assets? Is that investing in stablecoin issuers like Circle and like Coinbase? And, for now, we have indexes that serve both of those areas of the market, like our crypto equities indexes that do invest in companies like Circle, Coinbase, and others, or track those companies rather, and like our Bitwise 10 large cap crypto index, which tracks large cap crypto assets. We also have a DeFi index, which is a more direct play where you have lending protocols and trading protocols that operate on Ethereum. So I think ultimately our goal is to allow investors to express their conviction in areas of the crypto market that they believe are going to grow. And what I do know is, talking to investors, is tokenization is like the thing they keep asking about right now.
Right. Amazing. Yeah. So there you go, guys. That was Ryan Rasmussen, head of research at Bitwise, with an amazing set of insights and a great conversation. We are really grateful for you joining us, Ryan.
Yeah, Ken, Gabe, thanks for having me. Love talking with you guys, and hope to be back soon.
Brilliant. Really enjoyed that. Thank you.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.